April 2026 is here, and if you are over the age of 65 and planning to file your taxes, there is something happening right now that could quietly cost you thousands of dollars without you even realizing it. Welcome to Seniors Finance USA, your trusted place for clear, simple, and practical financial guidance made just for seniors. My name is David Miller, and here we break down everything you need to know about your money in plain English so you can make smarter decisions with confidence. Today, we're talking about a new tax rule that most people have not fully understood yet, including many tax preparers. And if this applies to you, missing it could mean losing up to $6,000 in deductions this year alone. No warning, no reminder, no second chance after the deadline. So stay with me, because in the next few minutes, I'm going to walk you through exactly what's happening, why it matters, and what you need to do before April 15th, 2026 to protect your money. Let's start with the most important point. There is a brand new tax form this year called Schedule 1A, and if you are 65 or older, this form is now required to claim a new senior deduction that could reduce your taxable income by up to $6,000 per person or $12,000 for married couples. If you file your 2025 tax return without this form, you do not get the deduction. The IRS will not automatically apply it for you. They will not notify you that you missed it. Your return will still be accepted, processed, and finalized, just with less money in your pocket. And that's what makes this so important. Now let's talk about why this matters in the real world, not just on paper. This year, Social Security benefits increased by about 2.8%. For most retirees, that meant roughly an extra $50 per month. But at the same time, Medicare Part B premiums went up significantly. So even though your benefit increased, a large portion of that increase was taken back before it ever reached your bank account. And on top of that, everyday expenses have continued rising. Groceries cost more, utilities cost more, property taxes are higher, prescription costs are up, so even though it looks like you got a raise, your actual purchasing power may have gone down. That's exactly why this new $6,000 deduction matters so much, because it's one of the few ways right now to actually put real money back into your pocket. Here's how it works. If you are 65 or older, you may qualify for an additional deduction of up to $6,000 if you file as an individual. If you are married filing jointly and both spouses are 65 or older, that number increases to $12,000. Now, this deduction is not unlimited. It depends on your income. If your income is below $75,000 as a single filer, you generally qualify for the full amount. If you are married and your combined income is below $150,000, you may qualify for the full $12,000. As your income increases beyond those levels, the deduction gradually decreases. And once your income reaches higher thresholds, the deduction phases out completely. But for a large number of retirees living on Social Security and modest income, this deduction applies fully. And depending on your tax bracket, that could mean saving anywhere from several $100s to over $1,000 or more. Now here's where things get even more important. This deduction is different from most tax rules. You can claim it whether you take the standard deduction or itemize. That's not common. Most tax benefits force you to choose one path or the other. This one doesn't, which means even if you've been using the standard deduction for years, you may still qualify for this additional benefit. But there's more happening this year that you need to know about. Because at the same time this new deduction was introduced, another major tax rule quietly changed. The limit on state and local tax deductions, what's often called the SALT cap, has increased significantly. For years, homeowners were limited to deducting only $10,000 in combined state and local taxes. That included property taxes and state income taxes. Now, that cap has been raised to $40,000 for many taxpayers. That is a major shift, and here's why it matters. Many seniors stopped itemizing years ago because that $10,000 cap made it pointless. But now, with the higher limit, itemizing may actually save you more money again, especially if you have higher property taxes, state taxes, or charitable contributions. So this year, you cannot assume that what worked last year is still the best option. You have to run the numbers both ways, because for the first time in years, itemizing may put more money back in your pocket than the standard deduction. There's also another change that many people are missing. If you are paying private mortgage insurance, that cost may now be deductible as mortgage interest. And if you made energy-efficient improvements to your home in 2025, like installing new windows, insulation, or a water heater, you may still qualify for tax credits on your 2025 return. But here's the catch. Those energy credits expired after 2025. So if you don't claim them on this return, you lose them. They don't carry forward. They don't come back later. That window closes. Now let me make this very real for you, because this is not just about forms and rules. This is about everyday people losing money without realizing it. Imagine someone living on Social Security with a fixed monthly income, carefully budgeting every dollar. They file their taxes early, thinking everything is fine, but no one tells them about this new deduction. No one includes Schedule 1A. And just like that, they lose hundreds of dollars they could have used for groceries, utilities, or medical costs. Not because they did anything wrong, but because they didn't know. And unfortunately, that's how this system works. The IRS does not correct your return to give you more money. It processes what you submit, nothing more. So if you miss something, it stays missed unless you go back and fix it. Now, let's talk about what you should do right now. First, if you have not filed your 2025 tax return yet, make sure Schedule 1A is included. If you are 65 or older, this is not optional if you want the deduction. Second, if you already filed your return and you did not include this form, you can still fix it. You can file an amended return, but the sooner you do it, the easier it is. Waiting only makes it more complicated. Third, take a closer look at whether itemizing might benefit you this year. Add up your property taxes, state taxes, mortgage interest, and donations. Compare that total to the standard deduction. Do not assume the answer. Check it. Fourth, if you made any energy-efficient improvements in 2025, gather your receipts and make sure those credits are included. And finally, make sure you have access to your Social Security account online. With staffing shortages and longer wait times, managing your information digitally is becoming more important than ever. Now let's take a step back for a moment, because I want you to understand the bigger picture. The system isn't designed to guide you step by step. It's designed to process information. That means the responsibility falls on you to know what applies to your situation. And I know that's not always easy, especially when the rules change, the forms change, and the information isn't clearly explained. But this is exactly why staying informed matters. Because the difference between knowing and not knowing can literally be thousands of dollars. So here's the bottom line. There is a new senior tax deduction available right now. It can reduce your taxable income by up to $6,000 or $12,000 for couples. But you must claim it using Schedule 1A. If you don't get it. The deadline to file is April 15th, 2026. And once that date passes, your options become more limited. This is not about fear, it's about awareness. Because when you understand how these changes affect you, you can make better decisions and protect your financial future. If this helped you, take a moment to like the video so more seniors can find this information when they need it. And make sure you're subscribed, because we'll continue breaking down these changes in a way that actually makes sense. Take care of yourself, stay informed, and make sure you don't leave your own money behind.